Hello and welcome to Inside ETFs. I'm Ramzan Karmali. Today we're looking at AI ETFs with Cinthia Murphy, investment strategist at VettaFi. In November 2022, ChatGPT was launched. Since then, investment in AI has surged. AI darling Nvidia has seen its value soar by over 700% in the past 2 years alone, and inflows into funds linked to AI have also risen sharply. But Joe Davis, Vanguard's chief economist, said this week that investors have gone too far in their bets on artificial intelligence's potential. So should investors listen to these cautious remarks from the world's second largest asset manager? Or is there still room in investors' portfolios for AI ETFs in 2025? Well, to help answer that and more, I'm joined by Cinthia Murphy from VettaFi. Cinthia, thanks so much for joining us. So what do you make of this warning from Vanguard's chief economist? Do you think he's right that Wall Street's AI-powered rally risks correction?
I think it's to be expected that Vanguard would feel that way. Vanguard, as we know, is very long-term minded. It's buy and hold minded, and everything about AI right now feels speculative. And if you look at the valuations of some of these companies, it's hard not to expect some kind of correction. But as a theme, it's really hard to argue that AI is not a long-term theme. And I think what we see with disruptive themes often is that you get to that first rush and things look a little bit out of control. I think we're going to start seeing the broadening of this theme and other companies' valuations kind of catching up. But, in general, from all the folks we're talking to, market experts and everybody, there's an expectation of a moderation of pace for sure. We're not going to keep seeing NVIDIA go out triple digits every year. I think we should see a moderation of the pace going forward.
Now, I know in the past you've said that you have to be smarter when it comes to investing in AI. So how should we choose the right funds?
Yeah, that's a great question. And by smarter, I mean, just to clarify, there's no wrong way. It's really whatever is the right way for you. What's been interesting in the ETF space that I found kind of, it really stood out to me is that for how much time we've spent talking about AI, if you look where the money has gone really in two main places. One is your mega cap, just tech play, and not really AI specific theme, like your Mag 7s. These companies we know have really led this space, or it has gone into the semiconductor story and leverage. So, a fund like, 3X semiconductors exposure or 3X NVIDIA specific. These funds have gathered billions of dollars. So folks have either really just bought the semiconductor story or they're still in the broad tech play. They haven't really put money to work in AI specific funds. And I think that will be where we see a lot of opportunity going forward.
So which do you recommend in the AI space, equal weight or market cap?
That's a good question too. And I mean, right now the concern is concentration. A market cap fund you have most of your exposure in 3, 4, 5 stocks. And that's never a very good way to approach the market because there's a lot of single stock risk in that approach. But the question really is who's going to win and who's going to lose in the race for AI. Right now, it has been just a few winners. That as that broadens out, it gets harder to know who's going to win and lose. And I think the concept of equal weighting is to mitigate that kind of risk that you pick the wrong name. But you don't necessarily have to go equal weight. Like there's really interesting funds that are trying to do that work for you. So if I can cite one example, XAIX, for example, from X Trackers by DWS, that's a fund it's an index fund, but the strategy believes the creators of the technology will lead, the adopters will lag. And so in that effort, the index looks for screens like revenue. So are the revenues being generated from AI activities or not? Do they have patents? Things that differentiate these companies so you can try to find the winners versus the losers going forward. So equal weight is one way to do that, or finding strategies that are, assessing that risk for you.
Now, over half the NASDAQ 100 index is made up of 5 AI-related stocks: NVIDIA, Microsoft, Apple, Alphabet, and Amazon. Wouldn't you be just better off investing in a NASDAQ ETF?
And a lot of people did. So I think if you look at QQQ and QQQM, they've together got more than $40 billion this year. It's your Mag 7 play in many ways, but you got to remember that the NASDAQ is not a technology index, it's a non-financials index. So a lot of folks tend to perceive it as a tech play. So just beware that that's not a tech index. So you may find things there that you don't expect.
And just finally, what do you think the return of Donald Trump will mean for AI if chip-related sanctions are tightened?
If I knew the answer to that, I'd be making a lot of money, Ramzan. In theory, it could be just the general idea that is going to be lower regulation and an opportunity for growth. I think that could be interesting. But anybody who knows what can come out of the next administration is in a good position. It's going to be really interesting to see what comes next.
Cinthia Murphy from VettaFi, many thanks for your thoughts. And that was your look at AI ETFs. I'm Ramzan Karmali, and this is Reuters.